In the lecture today, we will talk about common stock. So, common stock is the shares that you're familiar with that sell in stock markets. So the companies, corporations that sort of run the world these days have proportional ownership rights based on the number of shares a particular entity owns. So if I am an investor and I buy some shares of stock, that makes me a part owner of a larger entity. So this financial claim is an ownership claim on a corporation, and that corporation is expected at some point to distribute its earnings to its investors, either in the form of cash dividends or perhaps cash upon a merger or acquisition, or a liquidating dividend in the event of a Chapter 7 bankruptcy, if any. Often the distributions can be zero if it has negative value. But the point is, these are claims. They're long-lived claims. There's no maturity on common stock. So, and an investor may not see a cash return from the stock itself for many years. Now, there is an active secondary market in shares. And so in practice, achieving a cash return in stock is actually quite easy, because there are other investors willing to buy the share. But the shares themselves only pay when they pay a dividend, and that's basically it. Now, in the event of a merger, the shares are purchased, and so that's how the cash is received. So in general then, when we think about the value of a stock, we will think about the value of a series of dividends. Now, what about in the case of a merger? Well, in the case of a merger, the merging company will pay what they think the acquired company is worth, but their valuation is based on the stream of dividends they expect to receive from that company. And if that company's counting on a merger, then the next merger depends on the dividends, and so on, right? So everyone down the valuation line is looking to either their own dividends or dividends an acquirer would pay, and so a stream of dividends is really at the heart of what a common stock is worth to an investor. And so we would say that the value of any asset is the present value of its expected future cash flows. And for stock, that is the expected value of future dividends. So here, let's give an example. So let's suppose that there's a stock with zero growth. And therefore the dividend, whatever dividend is paid next period, is paid forever. Just dividend every period. And so the present value of those dividends would be the repeated application of the present value formula, or as we figured out in the when we were doing a checking account, a repeated payment over and over forever has a very simple valuation formula. It's dividend over R, or cash flow over R. So this is the perpetuity formula, but with new terminology, because we're applying it to a stock. So the perpetuity formula is the very simple cash flow over R. Because dividends grow over time, we will introduce a growth term, and there's some algebra you can do to identify the new formula, but it's not really worth walking through. You can take my word for it. The growing dividend, the growing perpetuity, looks just like the regular perpetuity, but with R minus G. So we have dividend divided by R minus G for a growing stream of cash flow. So this is growing in percentage terms. So if I have a $2 dividend and it grows by 5% every year, right, it'd be $2, then it's $2.10, then it's $2.20 something, and so on, right? It would just grow in percentage terms. And the value of that is the initial dividend divided by R minus G. And that's going to be our baseline model for valuing a stock, because we treat the dividends as a perpetual growing stream and go from there. So just as an example, suppose Big D Incorporated just paid a dividend of 50 cents. You can imagine maybe they're a basketball supplier with shoes specially designed to allow quick court movement. So we've got our basketball supplier, and they're paying 50-cent dividend, and they're expected to increase their dividend by 2% per year. So these dividends are going to grow. If the market requires a return of 50% on assets of this risk level, right? So if the required return is 15%, what's the value of the stock? Well, we know that the dividend is 50 cents. If it stayed 50 cents forever, it would be 50 cents divided by 2%, or divided by 15%, but we're growing, and so we would get 50 cents divided by 15% minus 2%. Now, if you look down below, that's not exactly what's there. So why is it 50 cents times 1.02 instead of just 50 cents? Well, the answer is that in the language. So if you see it, it says just paid a dividend of 50 cents. That means that happened in year 0, effectively, or quarter 0. Right? It just paid it. And if you look back at our formula, and this is also true for the perpetuity, we need dividend 1. We need the one in the future. We need next period's dividend, and that's consistent with when we were doing cash flows in the checking account problems, where if I invest $100 at 2% interest, I can safely pull $2 out every year so long as I wait. Right? If I want to pull $2 out right away, I need to put 102 in, so that way I pull 2 out, I have 100, it goes to 102, I pull 2 out, it grows to 102, I pull 2 out, and so on. So it has to be the future dividend. Since we're given the present dividend, we need to have it grow by the 2%. So, and they really are that straightforward. We're making some pretty strong assumptions on the dividend process for stock, which will relax. But given this universe, it's a simple application of the perpetuity with growth formula. So go ahead and try it. So there's a practice problem on the course page, so go ahead and give it a shot. Hopefully it goes well, and then we'll come back. We'll move on to more complicated, exciting things. Okay, so the previous problem assumed steady growth throughout the life of the stock, but this is generally not the case. So often we think about companies as having a startup phase where they lose money, a growth phase where they make money, but they keep all the money plus more from investors in the firm to grow, and then we have a plateau phase where the company has reached maturity, it's successful and large, and generates a lot of cash flow for its investors. And then there's a late stage where it's on the decline. So you can think an example of this kind of industry would be tobacco. So when the explorers came to North America, tobacco was one of the first successful exports that the colonies produced. And so even though it started with very small production levels, this increased over time until you have maybe the golden age of tobacco in the 50s or 40s in the United States, when cigarette usage as a percentage of the population was high, and then now tobacco is in the decline. Smoking percentages are going down, and in some cases being replaced by other products, and so you get this cycle. And so to model that, we need to apply different growth rates. So you have a positive growth rate in the early stage, and then a flat growth rate in the middle stage, and then a negative growth rate in the end stage. And so that means we need to break it up into some separate parts. And so the way to do it is to assume a growth rate for some period and then a different growth rate later. And so we have to calculate the new dividends using the repeated application of 1 plus the growth rate. Right? We get our old dividend back plus a little bit of growth. And so it becomes 1 plus g in the first dividend, and then 1 plus g squared for the second, because we multiply 1 plus g times the old dividend, which is already the old dividend times 1 plus g, the older one times 1 plus g. So they just accumulate up. It turns into a big multiplication problem, which we can combine together using exponents. So for a differential growth with 2 different g's, we can solve the problem in 2 different phases. You're finding, well, you find all of the relevant dividends up to the last one, and actually you have to go one more. So if you see there's that n plus 1 there in the slide, if I have 8 unusual growth years, I need to find those 8 dividends, and then I need to find the 9th one. Why? Because with a perpetuity, right, we always need the next one. We need one in the future to do it. And so if we have 8 unusual years, one in the future after we stop being unusual is 9. So you'll typically see these problems. You'll see it'll look like 1, 2, 3, 4, 5, 6, 7, 8, 8, right? Because the 9th dividend goes into a stock that we're valuing in year 8. And if we had 5 unusual growth years, we'd have 6 dividends, but the 6th one is included in the formula for the terminal value at year 5. So it's kind of a consistent pattern with these problems. Okay, so here we go. So here we're on a bit of an adventure. So suppose we're back at the bank. We're back at the bank, and we have the following opportunity to invest. Right? I can receive a checking account that has $1 after 1 year, 2 after 2, 4 after 3, 8 after 4, and so on. All the way up to 4,096, and then it stops. Okay, so we have a growing perpetuity here, except for it's really a growing annuity, right? It's a growing annuity. It stops. How can we find the value of that? Well, we don't need to go through all the details, but you can imagine the general idea of what we would do. This stock is growing at 100% a year, right? It doubles every year. But then at the end, right, that would be a perpetuity that grows forever. But at the end, we have to subtract a growing perpetuity that pays in the next period. Well, that would be double that, 8,192. And also growing at 100%, and subtract that from the first one. And what you'd get left over would be the value of that growing annuity. So we can do the same kind of argument we did to find the annuity formula, but do it with growing perpetuities instead of flat perpetuities. And that would be, and if we did that just in general, it would be a formula for a growing stock that ends at some point without paying a terminal dividend. And that formula can reduce us to this. So if I have a T-year growing annuity, you have 2 phases. So you do the T-year growing annuity for the dividend stream, and then at the end you do a terminal value of the stock at the for the last year. So if I have 8 unusual dividends, and then and then we go steady, you would do an 8-year growing perpetuity using the top formula, and then you would do the year 8 value of the stock using the growing perpetuity formula, discounted back to today. So really, it's like you get 8 payments and then you sell the stock is effectively how we're treating the valuation process. So that's a way to do if you have 2 growth levels just with one formula. But in general, a more general approach is to just write out all the dividends and use the present value formula. So that's what we're going to do right now. So I have a common stock. It just paid a dividend of $2. The dividend is expected to grow at 8% for 3 years, and then it will grow at 4%. So we have our growth phase, and then we have our maturity phase. And the question is, what is this stock worth? The discount rate is 12%. Okay, so let's go ahead and see with the formula. We get a value of 28.89, right, just plugging in, right? So we had, if we go back and look, 8% is our growth in the early part. So we have 2 times 1 plus g over r minus g. And then this is times this is the difference between two perpetuities, right? The first is a flat, the initial perpetuity, and the second is the growing perpetuity. And so we can apply the formula in this way, subbing in G1 and G2 for everything we need. But I actually prefer for these problems this way in Excel. So what we'll do is we'll go ahead and do this in Excel because that's probably the way you're most likely to be doing it. And so here we go, and let's get our, okay, so they just paid a dividend of $2. So the year 0 dividend is $2. Okay, well, let me move our window here to fit a little better. All right, so we just paid $2. And we need to know, right, how many unusual years do we have? That's important. How many years? 3 years, 3 unusual years. So we'll have 1, 2, 3. And we grow at 8%. So I'm going to take 2 and multiply by 1 point. And actually, if we're doing this smart, right, I will put 8% here and 4% here. Right, so there's my 2. So I'll say this is equal to this times 1 plus 8%. So we get our dividend that's growing. And then after that, right, so this is our dividend in period 1, period 2, period 3. Then after that, we grow at 4%. So we can find the next one, right, the next one, and we can make these a little narrower here. The next one only grows at 4%. So I'd say equals this times 1 plus 4%. Right, so what we've done is identify the dividends here. Right, so if I move these out of the way, right, this is the time and this is the dividend. Okay. And we want to know the value of this stock. And so what we'll do is first we need to know the value of this stream. Okay, so we can use the present value formula for that. Equals this divided by 1 plus r, which was not listed anywhere. I'll put it right here. To the power of 1. Okay, and we have 12% there. Right, so there's the present value. And the way I've created this, right, I can drag to the right. So this is 1, 2, 3, and then we're looking for another 3, right? That was the pattern. 1, 2, 3, 3. So this next pattern, we need the terminal value. So the terminal value is that growing perpetuity. So it's dividend divided by r minus g. Here's our r, 12%. And what's our g? Is it 8 or is it 4? We are in the second phase of growth, so it is 4. Okay, so there we get a dollar value there. And so now we want to find the, let's see. So now, wait, this doesn't look all right. This got too big. Okay. Whoops. Okay, what did I do? Did not lock in, right? So this should be A17 locked in. There we go. And now this should turn to something more normal. There it is. And then there's our final one right there. So, yes, don't forget to put F4 Command T on cells that are supposed to stay put. Now we've got a number that makes a little more sense, $32. So we can, and this is a year 3 value. This is a year 3 value. So we need to do a present value of that. Okay, so sorry, let me repeat what I just did. So I've got this number. I need to find the year 3 present value. All right, we need present values here. So I'm going to copy and paste this, but it's not going to work. Why? Because this is fine, but this is pointing at the wrong spot. Right, but I did that just as a shortcut because I can click and drag. Sorry, do you see that? So I moused over the right-hand side and got that little plus-looking shape. And you click and drag up to here. And now I've adjusted it to point at the right thing. Now it's pointing at E19 there. So now I've got the present value. This is also present value, right? This is a year 1 value, a year 2 value, a year 3 value, and this is a year 3 value. So I can add these up, equals sum, present values, and this. No. Okay, hold on. Plus this. There we go. And there's our 2889. So that's the value of our stock. Done the way I like to do it. So notice I didn't use the growing perpetuity formula for this. I feel like it makes things complicated, especially if you're doing multiple growth phases. If we had 5 growth phases, it would not be a big deal on this problem, right? We just have a couple more g's up here. We'd multiply that by the right g every period, and we're good. But with that other formula, you'd have to apply the growing perpetuity formula, growing annuity formula to multiple growing annuities. You're welcome to do it that way if that suits you. I think this way is easier. And now that I've done this, right, if I change this to 7, it's going to update everything. And so you can make yourself a nice little calculator, and it makes life a little easier. So that was an example of an unusual growth stock, right? 2 growth phases. Okay, so there's with the formula, with the cash flows. This just basically replicates what we just did in math rather than in Excel. And we're ready. So there is you try it on the course page. So go ahead and give it a shot. And I'm going to stop the video, and then when we start again, we'll pick up with other topics relating to stock valuation other than steady and differential growth.